Good afternoon, everyone. Hi, I'm David Cowan, President of the Museum of American Finance. Welcome back to our Lunch and Learn series, and today we welcome Mark Skousen to share with us Proverbs and Pearls of Wall Street Wisdom from his book, the new third edition, by the way, of the book, the Maxims of Wall Street, which will be on sale afterwards. Now, we use this book here actually at the museum when we want something pithy for an exhibit or perhaps for a pitch book. We turn to Mark's book for that. Now, a bit about Mark is he's got quite an incredible background. He is a financial economist by trade. You may be familiar, he puts that to constant use as editor of Forecasts and Strategies. He's the author of over 25 books. He's a frequent contributor to the print media, including Forbes and the Wall Street Journal. He is the producer of the Freedom Fest conference, which is in Las Vegas, that bastion of freedom, which lends me to ask Mark if what happens at the conference stays at the conference. He's got a teaching career that has spanned several universities, including the Columbia Business School, and in fact, the online university, Grantham, which serves many in our military, has named their business school in honor of Mark. Superscholars.org has named Mark one of the 20 most influential living economists, quite an accolade. He is a former economic analyst for the CIA. His undergraduate work was at BYU, and his graduate work was at GW. Now, there are two other items of note with Mark. First, I want you all to know he celebrated his 40th birthday with a bang, because it was on October 19th, 1987, which of course was the day of the great crash of the 1980s. And secondly, if you want to run and tune into your TVs afterwards, he's leaving right after this to go over to Fox to do an interview. Now, I couldn't resist ending this opening with some quotes, because obviously this is a book about quotes and maxims. So here are two, and there are, of course, quotes about quotes. The first one is from A.A. Milne of Winnie the Pooh fame. A quotation is a handy thing to have about, saving one the trouble of thinking for oneself, which is always a laborious exercise. So thank you very much, Mark, for helping us so we don't have to think. That's wonderful. And secondly is from Joseph Louis, a French Catholic parish priest and poet, who says, a fine quotation is a diamond in the hand of a man of wit and a pebble in the hand of a fool. Well, today, Mark, you are our diamond, and we look forward to hearing what you have to say.
Thank you. Delighted to be here to talk to you about a book that I have been writing for 30 years, maybe longer. Started collecting the sayings on Wall Street, like sell in May and go away, which is what a lot of students do when they graduate. So I've been collecting these since 1982 in a little notebook. And every time I would hear a great quote, I would put it down, write it down, and finally, like 3 years ago, a colleague of mine said, you know, nobody's ever published a book collecting all the sayings on Wall Street. I think I'm going to do it. And I said, oh, I better get this book out now. And sure enough, I got my book out. It is the one and only collection of Wall Street sayings. And I approached Wiley Publishing about putting this book out, because they publish a lot of classic books, like Reminiscence of a Stock Operator, for example. And they turned me down. They said, oh, gift books don't sell. Well, 20,000 copies later, I think I proved them wrong. And in fact, I had one trust company, the First Trust of Chicago, ordered a special edition with their own logo on the book for 10,000 copies that they gave out to all of their colleagues. So it is the kind of book that, as I will demonstrate, I think has a lot of wisdom. And you know, you have this quote here about if you have these little quotes, you don't really have to think. Something like that, you say something like that. But actually these quotes, it's amazing how one simple quote can have so much depth to it and will really make you think. And we will look at some of these examples as we go along, as I tell this story. So, bears make headlines, bulls make money. This is my subtitle of my book. It's a reflection of the reality, because the reality is, if you respond to advertising at all, it is the doomsdayers that get your attention. But they're not necessarily right. In fact, if you study the history of Wall Street over the last 100 years, 2/3 of the time, 67% of the time, the stock market's going up every day. It's going up. And only 1/3 of the time is it going down. So the bears are right. And what do we mean by bears? For those of you, we have a lot of students here, you may not be that familiar with the financial terms. What's a bear? A bear thinks the stock market's going up or down? Down. While the bulls think the market's going up. And the bulls are right 2/3 of the time in the United States. Now that could be different in other countries. If you come from Argentina, I can guarantee you that the stock market most of the time has been going down lately. In fact, most of the emerging markets have done very poorly. But the only country that has done really well recently is, believe it or not, Thailand, and they're having all kinds of problems, and yet their stocks keep going up. There's a lot of irrationality in the marketplace, and it's a tough business. I consider myself a survivor in this business. I publish a newsletter, brought one copy with me, forecasts and strategies. Now, of course, you may think it looks yellow, but it's supposed to be gold. Golden advice, you see. And I've been publishing this newsletter since 1980. And there are not very many newsletter writers who have published a newsletter for nearly 35 years. So I consider myself a survivor. Doesn't necessarily mean I beat the market every year, because I haven't. It's very difficult to beat the market. And I have a lot of quotes on that too, I think you'll find of interest. So, let me give you some of my favorite maxims, legends, and worldly wisdom based on my experience in reviewing the ideas and statements of a variety of people. We'll start with Benjamin Franklin, one of the founding fathers. Considered by many the father of American business. Alexander Hamilton would be the father of American finance. But Franklin was an entrepreneur extraordinaire. Great quotes here. An investment in knowledge pays the best interest. Definitely worth writing down. Any of you taking notes? No notes? Young people not taking notes? You're never going to get anywhere in life if you don't take notes. Well, some of you are eating, that's understandable. But my best students at Columbia Business School were all in the front row, and they all took notes, and they all got A's. The rest of them got B's and C's. And I was considered the toughest grader at Columbia University as a result, but that's another story. Nothing but honey is sweeter than money. I actually said that wrong. Nothing but money is sweeter than honey is the great quote. And let me tell you something. Money concentrates the mind. I can guarantee you this. You can have someone knock on your door and ask for a donation for a good cause, and you may or may not be interested in putting very much money into that kind of project. But if I told you to double your money in a year, you would throw money at me. Nothing but money is sweeter than honey. And another great quote which could be applied today in the business world and in government. There's much revenue in the economy. And no revenue is sufficient without it. Without economy. Now, if you don't understand that, you need to write that down and think about it. That quote right there will tell you more. It speaks volumes on how to live your life prudently and Stay out of trouble. So now let's move to a giant in finance, J.P. Morgan. I think you have a portrait up here. You have a statue of, you have a bust of John D. Rockefeller. J.P. Morgan saved the U.S. Treasury at least twice in the 1890s. And in the panic of 1907, saved New York from collapse. He's kind of the quasi-central banker, first central banker of the 1990s. So everybody should know about J.P. Morgan. First, J.P. Morgan is the name of a Wall Street firm. And it's been around a long time, established by J.P. Morgan in the 19th century. You can see he was the bull on America. The man who is a bear on the United States will eventually go broke. I quote that frequently to my doomsday friends. You're going broke because you're trying to short the market. And he has another great thing. You can't pick cherries with your back to the tree. Now, what does he mean by that? Any of you picked cherries before? You haven't lived till you pick cherries. You need to get out more. Just get 100 miles out of New York and you'll see cherry trees all over the place, especially coming into June. And see if you can pick cherries like this. You can't do it, can you? Because you're looking for the good, really good cherries. You have to be facing them. And what is he saying there? He's saying you basically need to know your business. The business of Wall Street. The business of investing is not the same as investing in a business. Okay? There's a difference between those two. Should I say that again? That was pretty fast, wasn't it? Investing in a business is not the same as, the business of investing is not the same as investing in business. Two separate animals. And what J.P. Morgan is saying is you better know your business. You've got to face the business. You need to be an insider, is what he's saying. Now, J.P. Morgan, I'm going to end my lecture here today by telling you my favorite J.P. Morgan story. And it has to do with a building that is only one block from here, 23 Wall Street. Now, unfortunately, the number, I don't think 23 is even good. I think they removed it. 23 Wall Street is the headquarters where J.P. Morgan had his offices, just a block from here. The most powerful man in Washington, in the United States, in New York. I'll tell you his story at the end. I want to show you this picture. This is an unadulterated picture of J.P. Morgan's nose. He had a disease, I'm not sure what it's called. You might want to come up close. For those of you who haven't, can you see his nose there? It's pretty grotesque. And he despised anyone who would photograph him. If you look at the portraits of him, his nose looks great, but that's what it really looked like. It was bulbous, bubbling, and he was a very fierce type of person. And you trembled in his presence. Trembled. John D. Rockefeller. John D. Rockefeller, this is a picture of him handing out a dime. He would hand out silver dimes to young people. And so here he is giving a dime to a young child. John D. Rockefeller was the wealthiest man in the United States as a result of making a lot of money in producing and distributing, primarily distributing oil. And John D. Rockefeller had kind of a perverse way of looking at things. He said, you know the only thing that gives me pleasure in life? Not my wife, not my children, not my grandchildren. It's seeing my dividends come in. Are you like that kind of person? You think that kind of person sounds materialistic? Well, you might say so. There's only one grandson of John D. Rockefeller still alive. Anybody know who he is? David Rockefeller is still alive. I think he's almost 100. Over 100. It's been a few years since I've seen him, but he gets out every once in a while. Now, here's a character that most of you have never heard of before, Jesse Livermore. Jesse Livermore is considered the speculator king. He's famous for shorting the market. What do we mean by shorting the market? For those of you students of finance, shorting the market means that you normally in a stock, you buy a stock and then you sell it as it goes higher. You make money. With shorting the market, you do the opposite. You sell the stock at a high price, and then hopefully you buy it back at a low price later on. So it's just the opposite. And if you didn't understand that, then this may not be your career choice. But anyway, he made $1 million. He became a millionaire 3 times in life. 3 times. So that also means he went bankrupt twice in between. So he was a speculator extraordinaire. Lived in New York City. And there was a book written about him called Reminiscence of a Stock Operator by Edward Laffitte. Here's a couple of quotes from him. The more I make, the more I spend. I don't want to die rich. Now, how many of you like that philosophy? Some of you, you're into the spending as well, right? Okay, how about you guys over here? You agree with that? The more I make, the more I spend. I don't want to die rich. Okay, how many of you disagree with that philosophy? How many think that you need to really save a lot of money and die rich and pass that money on to your heirs or to a favorite charity? All right, very good. I think it was Andrew Carnegie who said, the man who dies rich dies disgraced. That I don't put in the quote book. All right. So anyway, actually there's nothing wrong with that statement. The more I make, the more I spend. But if you follow the advice of Ben Franklin and also George Clason, who wrote a wonderful book called The Richest Man in Babylon. In the back of my book, I recommend certain books for you to read. So you don't necessarily have to read mine, but read some of these other famous books in the back. And one of them is by George Clason. This is a book you ought to carry at your bookstore. George Clason, The Richest Man in Babylon. So if you're interested in becoming rich, you need to read that book, Richest Man in Babylon, who said, basically, the more I make, the more I save. And so there's a big difference between spending and saving. People who are really successful in life tend to be misers. John D. Rockefeller was a miser. Andrew Carnegie was a miser. Joe Kennedy was a miser. Warren Buffett is a miser. Jesse Livermore died bankrupt. He committed suicide. And maybe it's because of number 2 quote, nobody's immune to sucker bets. Why, just last year, I won't even tell you how much money I put into an investment that turned out so far to be an absolute disaster. So nobody's immune to sucker bets, no matter how sophisticated they are. And finally, this quote, don't give me timing, give me time. What's he talking about there? In other words, don't worry about being right in the stock market as soon as you buy. Hopefully the stock will go up. You want over time to make money. See, here's the difference between gambling. A lot of people say, well, Wall Street is just another Las Vegas. It's not. It's very different. Now, it can be treated like a gambling casino, but it's not necessarily that. In fact, if any of you have played any games like blackjack, craps, you play any of these other kinds of, the slot machines and that sort of thing, what's the one lesson you learn? Okay. The one lesson you learn is don't stay at the tables too long. If you're making money at the tables, you want to walk away from that pretty quickly. Why? because the longer you stay, the more chance you are going to lose money. But in the stock market, it's just the opposite. If you invest in a good company, if you stay with it, you increase your chances of making money. So you see the stock market and Wall Street and Las Vegas are really very different type of animals, and especially if you give it some time. All right, now how many of you know about the Kennedys? You've all heard about John F. Kennedy, a president of the United States. We're honoring, or we're remembering, if you will, the 50th anniversary of JFK's assassination. His father was Joe Kennedy. And Joe Kennedy was both a good guy and bad guy on Wall Street. He's famous for engaging in very questionable activities in the 1920s when he had a hotel room at the Wilshire up the street, the Waldorf Astoria, not the Wilshire, the Waldorf Astoria used to place bets while he was in one of the rooms there. So Joe Kennedy, very interesting guy, but he had nerves of steel, very unemotional person. Very successful on Wall Street. If you're an emotional person, you're going to get taken over and over again on Wall Street. You're going to get carried away with the rise and when things are exciting and there's a fad going on. You want to invest in it. Joe Kennedy was not like that. Joe Kennedy was very objective in his analysis. And a great little quote, only a fool holds out for top dollar. Now he said this because he sold out 2 years, he sold out in 1927 during this rise in the stock market in the roaring 20s. And he sold out too soon. Stock market kept going higher, so friends of his would always come to me and said, "Oh, Joe, you really blew it. You got out early. You went down and bought real estate in Florida. You're living the carefree lifestyle, but imagine how much money you could have made if you stayed in the stock market." See? And so one day a shoe shine boy offered him a stock tip. And he said, "Any market that has a shoe shine boy recommending stocks is no stock market for me. I'm going to stay out." And he was smart to stay out because the stock market did in fact collapse. And so he didn't hold out for top dollar, but he did well. Now another very famous person on Wall Street, you guys have never heard of him, but he was an advisor to presidents. His name was Bernard Baruch. And Bernard Baruch said there's no more dangerous illusion than the belief that one can get something for nothing. And you get this all the time on Wall Street. Oh, there's a great opportunity. You can become rich. Well, there's an old saying on Wall Street. Here's what they say. They don't leave money on the table for anyone to take. We don't do that here in Wall Street. $5 bill sitting on the table right here. And none of you believe that $5 bill is there. Not even this guy was sleeping. Oh. $5 bill sitting on the table. Is that $5 bill there? I don't think so. It's not there. You do, yeah. Brokers never leave money on the table, so we just leave that right there. We're in violation. We're in total violation. You students are pretty slow. All right, so that money is not there. All right, so here's another great quote. If you have the cool nerves of a great gambler, the sixth sense of a clairvoyant, and the courage of a lion, you have a ghost of a chance of making money in the stock market. So what does he think about your ability to make money in the stock market? It's a little bit daunting task, isn't it? Daunting task. There's another old saying on Wall Street that the worst thing that can ever happen to you is to make money on your very first trade. Because then you think making money is easy. And it's not. It's tough. This is a very tough business. Right? So Bernard Baruch, I quote in the book his 10 favorite sayings about Wall Street, and they're really very valuable. Now, I know all of you students are never buy books, they're not interested, you can't afford them. If it's not on the internet, you know, it's hard for students even to buy textbooks and that sort of thing. So hopefully I can convince you to consider buying a book. I'm going to offer a special discount, $10 for students. Normal price for adults here is $20, but students only pay $10. All right. J. Paul Getty. Anybody heard of J. Paul Getty? How about, have you ever heard of the Getty Museum? The Getty Museum is here. It's on the West Coast. But J. Paul Getty was America's first billionaire. You know what he made his money in? Gambling. Oil. Not gambling. No, not gambling. Oil. So he has written a book called, another book that I recommend in the back of this book, called How to Be Rich. Now notice the title here, How to Be Rich. This is very different from Donald Trump's book, which isn't the Trump building right next to you guys?
Yep.
One of many. All right. Trump was a very famous person in New York. His book is called How to Get Rich. And see, there's a very big difference between how to be rich and how to get rich. How to be rich is still in print. How to get rich, like Donald Trump, is out of print. So what does that say? I'm recommending J. Paul Getty's How to Be Rich. So he has 12 pages in his book, How to Be Rich, on the stock market as an investor. And I highly recommend that. If you're going to read just one book, one chapter, 12 pages on the stock market, I would recommend J. Paul Getty's How to Be Rich. I recommend it. It's required reading for my students, even at Columbia University. Here's what he says. The seasoned investor buys his stocks when they are priced low and holds them for the long bull rise and takes it between dips and slumps in their stride. So if you buy good companies, you buy them cheap, hold for the long term. You'll make money. Now, think about this next quote, which is really dumbfounding. You may go counter to what you think. In times of rapid change, experience would be your worst enemy. And you know why? Because when major technological changes are happening, you will sit back and say, oh, this is a fad, fly by night, don't invest in those internet stocks. That's just a fly-by-night operation. So experience can hurt you in terms of that new technology. Even Warren Buffett himself says, I missed the whole technology thing. I missed it. And he's staying with the old, true, and faithful Coca-Cola company. That's what he invested in. But when he invested in Bill Gates, Microsoft, oh, no. I don't understand that. Computers, I don't get it. You know? I think it's $5 is still here. Okay. So, next quote. John Templeton. John Templeton, man I met several times, was the wealthiest ex-American in the world. In other words, he renounced his U.S. citizenship back in the 50s, moved to the Bahamas, lived a carefree, tax-free lifestyle in the Bahamas, and built himself a fortune. And John Templeton, wonderful man, established the Templeton Funds, bought out by Franklin. So here's a great quote. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. This is a wonderful description of the ups and downs of the stock market. So we should ask ourselves, where are we? Are we still in this, we've had this bull market now for 5 years. Are we still in the pessimism? Is everybody pessimistic about the economy? No. Are we skeptical? Second phase? Yes. Are we optimistic? No. We're still in the skepticism phase. So see, he would argue that the stock market is headed higher. Templeton would be fully invested in the market. So in my newsletter, am I fully invested? You bet, because I listened to what John Templeton told me. The public is right during the trends, but wrong at both ends, said Humphrey Niels, the father of contrary investment. That's a very profound statement. The public is right during the trends, but wrong at both ends. And finally, you must be a fundamentalist to really be successful in the marketplace. Now, he was a religious fundamentalist, John Templeton was, deeply religious man. But that's not what he means. In finance, a fundamentalist is one who looks at earnings, revenues, cash flow, the balance sheet, the earnings, quarterly earnings statements, all of these kinds of things. The technician, the technical trader, the chartist looks at prices and looks at volume and so forth, okay? And what Templeton's saying is you need to look at the fundamentals of a company, not just its price. And Warren Buffett is very much along in that same category. Warren Buffett would tell you, well, I'll give you a contrast there. I have 2 quotes that contradict each other in the Maxims. The first quote is, the only thing that matters is that the price of the stock is going up. That's all that matters. And then I have the Warren Buffett quote afterwards, which says, the worst thing you can do in buying a stock is just because it's going up in price. So he kind of takes the opposite point of view on that quote. All right, we move on now to Warren Buffett himself, who is the most successful investor of the last 100 years, purely as an investor and as a money manager. Berkshire Hathaway is the name of this company. He has a big annual event that occurs every April and May. He'll be doing his 50th next year. I plan to go. His 50th anniversary of his big shindig out in Omaha. So here are some great quotes from Warren Buffett. By the way, Warren Buffett loved my book, gives me a great endorsement. I found out why. He's quoted more than anyone else. So that's why he likes my book. You know, here's some quotes. Games are one. Now, if you look, you're into sports. How many of you guys like sports? We have a minority of Americans who like sports. This is unheard of. Is there anything else? What else is there out there? Okay. Games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. What does he mean by that? It goes back to that idea of John Templeton, fundamental analysis. Look at what's happening to the actual company, not what's happening to the stock price. How about this? You can't buy what's popular and do well. Interesting contrarian strategy. How about this? In the business world, the rear view mirror is always clearer than the windshield. So it's history. We all know history. That's really clear, but can we look into the future? What do we see? It can be cloudy. Our crystal ball can be cloudy. And then this wonderful quote here, my idea of a committee decision is to look myself in the mirror. It's a pretty good line. There's a lot of humor in this book that I collected over the years. A lot of it's cynical. For example, I have a whole chapter on how to become a millionaire. Any of you interested in becoming a millionaire? Just by a show of hands. Any of you? I don't think so, because this $5 bill is still here. So I'm not sure really interested. So anyway, how to become a millionaire? How do you become a millionaire? Whoa, wait a minute. No, that's yours. That's yours, because you all these clowns, you're the only one who had the guts to get out to the front of everyone. Wait, what is your name? Sulaiman. Sulaiman is going places. This man, I'm not only a millionaire, the CEO of a major corporation. I used to say he's going to be governor or senator or president, but nobody wants to do that anymore. So, congratulations. Very good. Very smart. Give him a hand. Got 100 on that. So you're halfway there toward buying them. It's about. All right. So how do you become a millionaire? All right. There's an old commodity trader saying, how do you become a millionaire? You start with $2 million. How do you become a millionaire? Start with $2 million. Very cynical. In other words, you're going to lose half your money. Old commodity line. All right. How do you become a millionaire? Start with $900,000. Think about that. Makes it a little bit easier just to make 10, 12% on your money. All right. How do you make $1 million? How do you become a millionaire? Marry a millionaire, or better yet, divorce one. That was from the latest Forbes magazine. That's pretty good. Richard Bronson said, how do you become a millionaire? Start with $1 billion and buy an airline. That can get you in trouble. And so there's lots of different ways. Here's the best one, I think. How do you become a millionaire? Borrow $1 million and pay it off. Borrow $1 million and pay it off. And I guarantee you, a lot of the people that have the buildings around here, this museum, have done that. Because it's largely borrowed money, leverage makes a difference. How are we doing on time? All right, about time to get to questions, but let's just get a few more quotes. Jack Bogle of Vanguard Index Funds. If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. I have to tell my subscribers this all the time. A stock will drop 5%, and I get letters. What in the heck is happening to this stock? 5% drop. And I always have to quote this. I said, look, just wait until 20% drop, then you can write me a letter. Time is your friend, impulse is your enemy. Very great quote, because you will hear stock tips all the time by people, especially around here in Wall Street. Ron Barron, you all should know about Ron Barron. He lives here in the city. He has the Barron Group of Mutual Funds, and he puts on the best show in the city among financial people. He does the annual one-day Barron Investment Conference at Lincoln Center, up in Midtown, and in the Opera House and some of the other breakout places. One-day conference, brings in the best investment advisors with the Barron Fund and some of the people that he invests in, and then he puts on surprise entertainment. You never know the names of the famous people, but he had Barbra Streisand last time. I mean, imagine getting a whole concert of Barbra Streisand, and it's free. Doesn't cost you anything, except you need to be a shareholder in the Barron mutual funds. So invest in the Barron funds, sign up. They just sent me the notice. Sign up and go. And I'm telling you, and they don't just have Barbra Streisand. I mean, they have Jerry Seinfeld. They have Bono, the musicians, and so forth. And they have special entertainment at lunchtime, and then the big entertainment later. And it's all free for clients, shareholders of the Barron Fund. So am I a Barron shareholder? You better believe it. Because occasionally there are $5 left on the table. And that's what Ron Barron has done. Nobody else does that. Warren Buffett doesn't really do that. Well, I mean, you go to Omaha. Who wants to go to Omaha? New York City? Are you kidding? Yeah. Okay. Richard Russell. He outlasts me as writing the newsletter for the longest, over 50 years. Editor of the Dow Theory Letters. He says, this is a great quote. if you ever get stuck losing money in a bear market, which we did back in 2008, 2009, in a bear market, the man who wins is the man who loses the least. Because in a bear market, I guarantee you, everybody loses money one way or another. And if you made money in the stock market by shorting it, you probably lost money on the real estate you were owning during that time period. So in a bear market, the man who wins is the man who loses the least. And I like this little quote: a bull market bails you out of all your mistakes. Bear markets make you pay for your mistakes. That's a pretty good line. Jim Rogers, who's a real bon vivant, lives in Singapore. This is a picture of me with Jim Rogers and my grandson right there in the middle, who's 10 years old, and he got up there in front of Jim Rogers and said, "Do you have any small cap stocks to recommend for a small person?" Pretty clever. He came up with that on his own. So anyway, the more certain something is, the less likely it is to be profitable. And he says, "Go west, young man, all the way to China." He lives in Singapore. He believes the future belongs to the East. And here's Steve Forbes. Steve Forbes is a co-ambassador to my Freedom Fest conference. He's a dear friend of mine. We spent a lot of time together. Here's a great little quote. If you want to say hello here. Everybody is a disciplined long-term investor until the market goes down. If you ladies ever get into the stock market, you're missing out on all of these great quotes. But that's okay. Life is full of variety. So here's a quote from Warren Buffett, a great little book. I plan to shamelessly steal some of the lines. And that is not a Photoshop. Okay. And a couple other quotes. This fellow up here is Dennis Dartman, a commodity guru, who's on TV all the time. I keep it on my desk and recommend it to everyone, he says. So these are just little quotes from a variety of friends of mine about my book. This is my conference that we hold in Las Vegas every year. Our theme is Big Brother. Steve Forbes and John Mackey, the CEO of Whole Foods Markets. All heard of Whole Foods? They're there all 4 days. They don't come in, give a speech, and then leave like at other conferences. They're all 4 days. So that, I won't say no more about my conference, but it is a lot of fun. So let me end with my JP Morgan story. Or I'll tell you what, let me take some questions, and just a couple of questions, and then I'll give you my final JP Morgan story. Does anybody have any questions about anything I've covered? No questions? Ready for the story? Yeah.
Can you just tell us why, you explained bear and bull, but what's the significance? Why would a bear be a down market and a bull be a up market?
Well, bears hibernate, okay? Bulls don't. I think the origin, and you may...
A lot of times we say, that the bear swipes down and a bull charges up.
Oh, that's good, yeah. Yeah. The bull charges up. That's good, yeah, and the bear swipes down. But I always thought it from hibernating, going to sleep, so that the stock's not rising, they're slumbering. But I like that one. I like that explanation.
Any one question?
Yeah.
Did you have any mentors in life, or are you self-taught for the most part?
Well, my father died when I was 16, so I think I became independent in seeking out other people to have some influence on me. And I've always tried to seek out, a lot of these, the last 7 or 8 people, I've met all of them myself and developed a friendship with them, from Warren Buffett to Steve Forbes and so forth. And mentoring is extremely important. But you have to push your way. You have to push your way into getting the attention. I mean, I teach right now at Chapman University out in California. Okay? So I have 36 students. And only one student has followed up and met with me and talked about his career and what he's trying to do and stuff like that. One student. The rest of them are running around and who knows what they're doing. And that's okay. They may have their own other mentors. But mentors are really important. And Since my own father was not there, I sought it out from other people who were successful, hopefully, in life. So that's my idea, anyway. Well, let me tell you one other question.
Yeah, I like your analogy with the, the investing versus speculation in the market. But I was wondering, percentage-wise, looking at the casino side, there's certain shares the house takes, and I'm looking at like flash trading, and there's a certain amount of money that's being taken out of the market just from people thinking they can get a jump on someone else. So
Yeah.
looking at that amount of money versus what it used to be, say in the 80s, do you think that's more money being taken out of the market? Is that a significant amount?
Yeah.
Is that going to change over the next 10 years?
So I can tell you that in the 40, 50 years that I've been following the market, investing in the market, and so forth, that this is a tempest in a teapot, this stuff about taking little bits and stuff like that, flash trading and that sort of thing. Commissions have dropped dramatically, volume has increased dramatically, bid-ask spreads have collapsed. It's a wonderful time for individual investors to be involved in the marketplace. You almost don't even have to worry about these costs. Even insurance companies, which used to rip people off big time, are having a much more difficult time doing that with their annuity products and that sort of thing. I think the marketplace has really, the competitive nature of the marketplace has increased dramatically due to technology. The internet and so forth is really, so, this stuff that Michael Lewis is talking about and so on, I mean, it's just paint. It's just nothing. And if they become billionaires, more power to them of people who do that. But they're not screwing the small investor particularly. So I don't buy that argument at all. I don't know if you've had him speak here or not, but
Costs too much money.
yeah, that may be the case. Was there one other question? Yeah.
As an academic economist, what school do you follow?
As an academic economist, what school do I follow? Well, I actually have kind of a foot. If I had more than 2 feet, I would have feet in all of these schools. I'm actually doing a course called the Warren Schools of Economics for the teaching company. So this is, if you've seen these full-page ads in the teaching company about learning with audio tapes and that sort of thing. So I'm doing that. And I have sympathy with all of the schools. I've learned something from the Keynesians, the Marxists, the Austrians, the supply-siders, the Chicago School, all of them. I think if my bias is toward the Austrian school because I tend to be libertarian. I don't like government involvement. I like to minimize government involvement. Ben Franklin, I think, said it best. He said, a virtuous and industrious people may be cheaply governed. So I'm most in that camp, but again, I read them all. On Fox News, I'm debating a Keynesian on the Piketty book on capital and income inequality and that sort of thing. I mean, if you want to talk about equality, this is all you need to do. This is equality for everybody. Every one of you have one of these, right? A smartphone. Is there anyone here in this room that has a smartphone? Oh, all these old people. Let me tell you, this is a great econ. Well, I've got to sign a few books and get moving here. So let me tell you my J.P. Morgan story. And I have it in the end of the book, so if you want it, you can have it there. J.P. Morgan lived at 23 Wall Street, and just walk by there after you hear this lecture. And there was a commodity guru, a commodity trader out of Chicago, had never been to New York, and he decided that he wanted to come visit him. The commodity trader was a bear. He was always doomsday. He said, oh, we're headed for another depression, stocks are about to crash, and you better buy gold and so forth. On the other hand, as you know, J.P. Morgan was a bull. He was always thinking that things were looking very positive. And they would have these arguments. Well, finally, the commodity trader from Chicago came and visited J.P. Morgan to see New York for the first time. And he came up to the second floor. They had a discussion right before lunch. The commodity trader was bearish. the J.P. Morgan was bullish. They had their differences, and then they decided to go out to lunch. So they're walking up Fifth Avenue. And as they're walking up Fifth Avenue, the commodity trader from Chicago had never seen these beautiful, magnificent skyscrapers that went up, like the Woolworth building and so forth. And was just absolutely mesmerized by these skyscrapers in New York that he'd never seen in Chicago. And J.P. Morgan finally stopped him, and he said, you know, it's a funny thing about all those skyscrapers. Not a single one was built by a bear. Thank you all very much.